Hello everyone, welcome to our YouTube channel The Candlestick Masterminds. In this video, we'll discuss about the Camarilla pivots. Let's start the video. The Camarilla equation offers a series of price-based support and resistance levels with each level carrying a specific call to action. The Camarilla equation was first discovered by successful bond trader Nick Stott in 1989. He penned an equation that led to the brilliant and oftentimes unbelievable levels that so many traders have used to profit in the market. The word Camarilla literally translates to a group of secret private advisors in Spanish. What makes these pivot levels work so unbelievably well is the fact that traders are watching and trading by them, creating a self-fulfilling prophecy. The more traders that trade by the same equation, the more prominence these levels will carry. This equation takes the prior day's high, low and close to determine 8 key levels on your chart. 4 support levels, that is L1, L2, L3 and L4, and 4 resistance level, that is H1, H2, H3 and H4. The standard Camarilla pivot formula is shown. Just have a look at the equation for each level. The Camarilla equation offers a powerful method of trading the market because the call to action is always the same. The equation forces you to recruit your inner discipline to trade on the right side of the probability. Traders take similar positions at each level, thus creating a powerful form of self-fulfilling prophecy. The pivot levels in the indicator are usually color-coded to remind you which actions to take when certain pivot levels are tested. The H3 and L4 pivot levels are typically colored red because these are the zones where you should be looking to sell the market. Likewise, H4 and L3 are typically colored green to indicate long action levels. Traditionally, the most important levels are the third layer of support and resistance, that is L3 and H3. Once the market reaches these levels, you typically see a reversal back towards the mean. Therefore, you are typically looking to sell the market at H3 resistance and buy the market when price tests L3 support. Once price pushes too far in one direction, responsive market participants enter the market in order to push price back towards perceived value. The third layer of the Camarilla equation is visually displaying price levels on the chart where responsive market participants are likely to enter the market in order to push price back towards an area of pivot prior value. This is the reason the third layer of the indicator can have such an impact on price on any given day, especially when the market displays certain market tendencies. The first and second layers of the indicator, that is L1, L2, H1 and H2, are typically ignored and generally not even plotted. The fourth layer of the support and resistance is very important, as this is the layer is seen as the last line of support or resistance and is watched very closely for a breakout or reversal. Traders of this system will watch the fourth layer of the indicator for a breakout. H4 resistance is usually colored green to denote a bullish breakout, while L4 is colored red to represent a bearish breakout, while the third layer of the indicator visually represents where responsive market participants are likely to enter the market. The fourth layer illustrates price levels where initiative market participants are likely to act. Since the fourth layer of the indicator is typically seen as the last line of support or resistance, it makes sense that a break would likely lead to a range extension via initiative buying or selling pressure. Therefore, breaks through these levels usually lead to trending moves in the direction of the break. In addition to watching the fourth layer as a breakout zone, it is also found that this layer to be as prone to reversals as the third layer, thus allowing to play to as L3 and H3. Therefore, it could be said that the fourth layer of the indicator offers the most versatility. The fifth layer, that is L5 and H5 of the equation, generally serves as a target should a breakout through L4 and H4 occur. Keep H5 and L5 as blue or black lines so that they are not easily confused with any other Camarilla level. The expanded Camarilla levels are H5 and L5. You can see this is the sell level. L3 is buying level. This is bearish breakout. This is bullish breakout. This is the target. This is the target. The third layer of the indicator is where the market is likely to reverse due to responsive parties. The fourth layer is where breakouts are likely to occur due to initiative parties. The fifth layer serves as a target should a breakout occur through the fourth layer. The reactions at these key pivot levels can be simply amazing in a time when the market can be all over the map in terms of volatility. These levels can provide a sense of calm while navigating the high seas of the market. The Camarilla equation is like a built-in trading system, complete with entries, stops and targets, all built into one indicator. There are two basic setups that the Camarilla equation offers: two reversal plays and two breakout plays. This trade, that is H3 reversal trade, this trade occurs when the market advances to the red, that is H3 pivot level, and begins to lose momentum. At this point, responsive sellers are likely to enter the market and push price back towards perceived value, essentially forcing price to revert back towards the mean. Any signs of weakness at H3 should be viewed as a selling opportunity, as this is the first major level of resistance identified by the indicator. According to traditional Camarilla strategy, any short positions taken at the H3 pivot level should carry a stop loss at or just above the H4 pivot level. Along the same lines, your target should be set to the green L3 pivot level, which is the first major level of support identified by the indicator. You can see market opened here, it went up to H3. From here the selling pressure came and the market reached L3. This is the target, this is the entry. This is a simplified example to enter and exiting a trade. Actual entries can be much more complicated at times. In the illustration, you see the first candle that reaches and extends beyond H3 is a bearish candle, as evidenced by the wick at the top of the candlestick. This candle opened and closed below H3, but the wick extended beyond the pivot level, leaving a bearish shadow. This type of bearish reversal wick is the first indication of weakness at this level. Some traders may want to enter this trade based on this criterion alone. For more confirmation at this pivot level, following question need to be answered. Does H3 coincide with the visual price resistance in the chart? Has price been in a downtrend the last few days? Have any key candlestick setups formed at this level, at this pivot level? A basic yet powerful form of confirmation is to see how the following bar reacts after the initial test at H3 occurs. If the following bar's high falls below H3 and its close is below the prior bar's close, you have all the confirmation needed to fire off a short trade. Your entry would occur at the close of the confirmation bar or at the open of the following bar. You would then look to offset the trade once your target is reached at L3 support. Look at this, market opened here, it went up to H3 level. From here selling pressure came and eventually came down. Again market opened here, it went up to H3. Here a doji pattern formed and market fell, reached the target of L3. Same. You can see market opened here. It pierced H3, but eventually selling pressure came from here and the target achieved. H3 reversal trade. This is a 2-day chart of TCS. On 23rd September, TCS reversed from H3 and a short trade at H3 achieved a target at L3 and beyond. The same TCS on 22nd September pierced through, reversed from H4 instead of H3. It did break the H3 in a single 5-minute candle. The above price action shows that it is not always true that price will reverse from H3. Instead, it might reverse from next pivot. Basically, an inverted version of the H3 reversal trade is L3 reversal trade. The goal of this trade is to buy at L3 support with the targets set to H3 resistance. Stops would be held at or just below the L4 support level. If price drops to L3 pivot level and begins to see initial signs of strength, responsive buyers are likely beginning to enter the market with the intent of pushing price back towards higher value. Responsive buyers are seeing value at lower prices and are looking to capitalize on this bargain opportunity. Method for confirming the reversal would be to look to the bar that follows the initial test at L3 support. If this bar closes above the prior bar's close and its low is above the L3 pivot level, there is enough confirmation to fire off a long signal. Any of the major The stock opened the day with early weakness and quietly tested L3 support within the first 30 minutes of the day. After testing L3 support, stock formed a moderately bullish reversal wick at this level. The following bar's low was above the L3 pivot and its close was above the prior bar's high, completing the necessary requirements for a long signal. You would then enter a long position at the close of the second bar or at the open of the following bar with the target set to H3 resistance and stops at L4 support. In this case, stock trended nicely higher and eventually reached H3 resistance to complete a successful trade. There are several factors to look for trading a third layer reversal trade. The current trend, the prior day's price behavior, visual support or resistance in the vicinity, and price to pivot behavior. From our study of both the money zone and floor pivots, the prior day's trading activity can have a huge influence on the next day's trading behavior. If the prior session was a trend day, you are more likely to see trading range behavior in the next day's market, which means reversal at H3 and L3 are more likely to occur. Along the same lines, if the market has been trending higher for a period of time, any pullback to L3 should be seen as a buying opportunity. If the market is in an existing downtrend, any pullback to H3 would be viewed as an opportunity to sell the rip. The ability to quickly recognize the market's context clues will allow you to get a feel for how price may respond to certain Camarilla pivots. The standard fourth layer breakout. It is H4 breakout trade and L4 breakout trade. See, this is the H4 trade breakout trade. This is H3 level. Market opened here. It tested H4. It came back, again tested H3 and again tested H4. It showed a little bit weakness here, but eventually this candle broke H4 and the breakout happened and the target of H5 achieved. The basic premise of this setup is to trade a breakout through H4 resistance with a target set to the H5 pivot level. Stops are traditionally held at or just below the H3 level. H4 represents the last line of pivot resistance as seen through the eyes of the indicator. The market has to decide whether it will break through or bounce off this last line of defense. If a break occurs through this level, you typically see a rush of buying pressure that catapults price vastly higher as initiative buyers begin to step into the market to advance price to higher values. When H4 is crossed with plenty of energy, the market can break away from the prior range at an advanced rate of speed, reaching the H4 target in a matter of just minutes. While the H4 breakout plays looks easy to trade, it can actually be quite difficult for traders that are new to trading with the Camarilla equation. The reason is that H4 is typically considered a breakout level, but it is actually more of a last line of resistance. What happens when the market tests the last line of resistance? The market fights with this level tooth and nail, and most occasion as bulls and bears battle for control. This struggle causes price to weak resistance many times before direction is ultimately decided. These wicks are what cause headaches and frustration for new traders of the equation. When newbies to the Camarilla equation learn that H4 is to be bought for a breakout opportunity, they generally buy the first touch at this level, which typically results in a losing trade. On most occasions, the market has to test this last line of resistance before making a decision to head higher. Therefore, the best course of action is to watch behavior at H4 and allow it to form a natural price resistance until a solid breakout occurs by a bullish candle. A close above this resistance level is typically the confirmation required for a bullish trade. Notice the first 5 candles at H4 were basically testing this pivot level for either a breakout or reversal, with each candle closing below the pivot but leaving wicks above it. Eventually, the 6th candle of the sequence led to a breakout through H4 and closed above the highs of the prior candlesticks. This is the candle that should be bought for a ride to the H5 target, as initiative buyers have clearly begun to step into the market. Obviously, not all H4 plays are the same, but having this bit of knowledge will save you some frustration and will surely advance your learning curve. Once the contract opened the day in strong fashion and rallied from W support to H4 resistance but stalled precisely at this level, novice traders would automatically buy a touch at the H4 pivot level. After all, it is a breakout level, but this trade usually fails since the market must test the last level of resistance before moving higher. The market tested H4 several times with multiple wicks and eventually pulled back to H3, which would have stopped out novice traders, as stops are generally set to this level for this type of trade. Eventually, price reversed off H3 using it as a support and rallied through H4 resistance. The key is that price tested H4 pivot level and closed above this line of resistance, which ultimately confirmed the long trade opportunity before reaching H5 target. It is the bearish version of the H4 breakout trade, that is L4 breakout trade. For this trade, you should enter short trades upon a close below the L4 support level while setting your stops at or just above L3 and your target at L5. Since L4 represents the last level of pivot support for the market, you may see a struggle at this level before a breakout or reversal occurs as bulls and bears battle for territory. Eventually, initiative sellers enter the market in order to extend the day's range downward. See, market opened here, it tested L4, it went up, again tested L3 several times and eventually broke out of L4 and reached the target of L5. You can see here, market tested here, went up, again came down, tested here again, and it broke down with this red candle and reached the target. With the H3 reversal trade, there are several factors that can be judged to help you determine if a successful H4 breakout trade is likely to occur. The current trend, the prior day's trading behavior, and where the price opened the current session in relation to the pivots all are key factors that can result in a high probability H4 breakout play. If the market has been trending higher in the days leading up to the current session, you are likely to see a responsive buyers enter the market upon a pullback to the L3 support level. Bullish trending markets from higher lows and higher highs. If responsive buyers enter the market on a pullback to L3 support, you are likely to see price reach a new high within the uptrend, which generally means a move to H4 or H5 once initiative participants take over the move. If the prior session was a trading range or sideways day, price is likely to trend in the current session, meaning that a push to and through the fifth layer of the pivot is very likely. On the flip side, if the prior session had a wide range of movement like on a trend day or double distribution trend day, the market is likely to trade in a range in the current session, which doesn't bode well for a Camarilla breakout opportunity. This behavior actually sets up much better for the third layer reversal plays. See, market opened here, it tested Camarilla L3. From here, buying came, it reached the target of H3 and beyond H4 and H5, causing a trending day. The market opened above H3, H4 and tested H4 and target achieved at H5. Market opened below H3 and it tested L3 from where buying pressure came and it achieved target of H3, H4 and H5. It's also an example of Camarilla trade. Pivot width analysis. When using the Camarilla equation for pivot width analysis, I use the pivot width of the third layer of indicator from L3 to H3. Pivot width plays an important role in your ability to anticipate market behavior. An abnormally wide pivot width usually leads to trading range activity, while an abnormally tight or narrow pivot width typically yields breakout and trending behavior. When the width of the pivot is unusually wide or unusually narrow, the chances for forecasting price behavior increases. If pivot width is of average size, then no real behavior cues can be gleaned with any degree of accuracy. You must be disciplined and honest in your approach for deciphering important pivot width characteristics. It was a sideways day in the previous day, so that the today's H3 and L3 is very narrow, resulting in a trending day. It is important to note to overlook the opening price in relation to range and value. Remember how the market opens the session with regards to prior day's range and value allows you to judge the market's conviction. There is acceptance or rejection for every analytical forecast given. If the pivot width is abnormally wide for the following day, it is safe to anticipate a sideways or trading range day. Acceptance of this view will take place if the market opens within the prior day's range and within the third layer of the indicator for the current day, as was the case on March 11. If the market had opened the day outside the prior day's range or outside the third layer of the indicator, market conviction would have led to a different outcome. Likewise, acceptance of a narrow pivot range forecast occurs if price opens the day beyond the prior day's price range and preferably outside the third layer of the Camarilla indicator. This indicates the market is ready to seek new value, thus confirming the breakout or trending behavior that narrows pivot typically forecast, which occurred on March 12th. This is a narrow pivot width. This is wide pivot width, eventually causing a breakout trade. This is wide pivot width. This is narrow pivot, resulting in a breakout. 2-day Camarilla relationship. 2-day relationships are extremely important when using pivots in our trading. These relationships give you a directional bias and allow you to anticipate potential market behavior for the upcoming session. These relationships are the same as CPR, which we mentioned in the CPR video. When using the Camarilla equation, the 2-day analysis uses the third layer of the indicator instead of the value area or the pivot range. See, this is a very narrow pivot range which caused a trending day. A trending day resulted in a very wide H1 and L3, H3 and L3, which resulted in a typical day. 2-day Camarilla relationship. There are total 7 Camarilla relationship, that is higher value, overlapping higher value, lower value, overlapping lower value, unchanged value, outside value and inside value. Higher value indicate bullish trend, overlapping higher value indicates moderately bullish, lower value indicate bearish trend, overlapping lower value indicate moderately bearish trend, unchanged value indicate sideways or breakout, outside value indicate sideways and inside value indicate breakout. These are the 2-day Camarilla relationship. This is unchanged value, this is outside value, this is inside value, this one is higher value, this is higher but overlapping, this is lower value, this is lower but overlapping. The first and second layer of the Camarilla indicator are likely a swimming pool. You don't always use it, but when the day is nice, you enjoy a swim. That is the hidden layers. The first and second layers of the Camarilla equation is known as the hidden layers. However, given the right circumstances, these levels can be extremely useful to our trading. Since the prior session's high, low and close are used to calculate the pivots for the current day, the prior day's range will dictate when it is useful to trade from the hidden layers of indicator. When the prior day's range is excessively larger than normal, the pivots for the following session becomes abnormally wide, thus allowing you to profit using these hidden layers. When this occurs, you can basically ignore all pivots outside of L3 and H3 as the market will likely become trading range bound. Unlike the money zone and floor pivot indicators, the Camarilla equation provides a better way to play trading range and sideways days when the pivots are unusually wide. See, here you can see all Camarilla pivot levels are very close to each other, resulting in a trending day. And after this trending day, you can see the Camarilla levels are placed very widely. You can see this is L1, L2, L3, L4, and you can't even see the L5. Okay, this one is H1, H2, H3, and H4. All these levels are placed very widely. If the Bank Nifty were to have a range of over 1000 points, the next day's pivot will be vastly wider than normal. If you are looking to trade a reversal of H3 to the traditional target of L3, you are less likely to reach your target since these pivots are spaced wider apart than normal. Actually, you may not even have a chance to trade on L3 or H3 reversal because of the pivots may be so wide that price may never venture out from the inner two layers of the indicator. These are the first three Camarilla layers. H1, H2 and H3 all are bearish reversal zones, and L1, L2 and L3 all are bullish reversal zones. Keep in mind that unlike the trading dynamic of H3 and H4 or L3 and L4, where one pivot is played for a reversal and the other a breakout, the hidden layers, that is H1, H2, L1 and L2, are always played for reversals, just like the third layer of the indicator. H1 and H2 are to be played for bearish reversals like H3, and L1 and L2 should be played for bullish reversals like L3. This type of relationship falls perfectly in line with how a trading range day should be played. As a thumb rule, any time the market experiences a trending session or a session with a wide range of movement, you will want to consider turning on the hidden layers of the indicator the following day. The professional traders are quite content taking smaller moves within a clearly defined trading range. They will continuously scalp 20 to 40 points from Bank Nifty throughout a session. Not every trade becomes a 100-point winner, but every 100-point winner was first a 20-point trade. Remember, trades do not like obstacles standing between their trades and potential profits. Trying to ride a trade to a 100 plus point intraday target from L3 to H3 in this case can be an obstacle on many days. Instead, the inner layers of the indicators provided the same reliable pivot behavior but reduced the inherent risk typically associated with wide price ranges. Great traders do not require profits to be large, only that profits are quick and painless. Trading range behavior was clearly dictated by the inner two layer of the Camarilla indicator. Every reversal on this day was quick and decisive, which is typical of a trading range day. On this type of session, you must be decisive at the point of entry and steadfast to your target. On any of the key reversal patterns discussed earlier can be very useful on this type of day, and the ambush entry technique becomes especially important as well. On this particular trading days, volatility is typically very low, therefore you are looking to take quick profits while limiting your risk. The inner layer of the Camarilla indicator could be your edge that gets you through this type of session profitably. The Camarilla breakaway play. The trend day can be one of the most explosive days the market has to offer. It is very important to develop your ability to prospect and anticipate this type of session before it occurs. Your ability to properly diagnose and trade the trend day using the pivots can easily take your trade to the next level. True trend days typically begin the day with a bang, usually with a price gap that occurs beyond the prior day's range and value. However, you do not want this tip to be your first indication that a trend is in full swing. Instead, a fully prepared trader will use this information as a confirmation that a trend day has started, since pivot characteristics would have already alerted the trader to the possibility of a trend outcome. Dynamic Camarilla 3 indicator clearly alerts you to an inside value relationship for the next session, as both lines of the developing indicator lay within the third layer, the static Camarilla indicator. This two-day relationship has a keen sense of snuffing out breakouts for the upcoming session, especially if the pivots creating the inside relationship are extremely narrow as they are in this example. Armed with this insight, we can now wait for a gap at the open of the following session to confirm a potential trend day scenario, as a gap in their direction will likely spark a beautiful trending day. If a gap does not occur at the open of the following day, then you must watch the prior day's price range for signs of a violation in order to confirm range extension. We can see on prior day H3 and L3 are wide, which resulted in a sideways trending day, and today's H3 and L3 are very narrow. The market opened higher and it trended. The stock opened the day with a bullish gap that occurred above the prior day's price range and above the current day's value, which is seen as the third layer of the Camarilla indicator. You usually want the gap to occur beyond the third layer of the indicator, but not beyond the fifth layer, as this gap may be too big for the market to digest. At the opening print confirms a breakout, I usually watch the first 5 to 15 minutes of action for further confirmation that a continuation will occur. In this case, stock raised out of the gates in the first 15-minute bar, which is enough confirmation to place a long entry at the open of the following candlestick. True trend days usually close at or near the day's extreme. Keep in mind, since the pivots are usually narrow on days when the market breaks out, you will not usually look to take profits at the fifth layer of the indicator, as this will not do your trade justice. While narrow pivots and inside value relationship allow you to spot a potential trend day easily for the upcoming session, sometimes it's unexpected breakouts that can offer huge results. In a bullish trend, you will look to buy any pullback to L3 or H3, and in a bearish trend, you will look to sell any pullback to L3 or H3 depending upon where the market opens the day. However, if price opens the session with a gap that is completely against the grain, this is a big indication that market sentiment has changed and participants are likely seeking new value. Spotting these days can be easy, but only if you do your homework. Trading is about finding these familiar patterns in the market, capitalizing on the highest probability opportunity. Even in the shortest of trends, you will begin to see how every pullback to L3 or H3 will be an opportunity to either buy the dip or sell the rip. The smart money enters positions at the most favorable spot in the chart, and pivot trend analysis allows you to spot these opportunities with the best of them. Pivot trend analysis is one of the most powerful and successful ways to analyze the trade a trending market. Throughout the presentation, we discussed the importance of recognizing the trend of the market while playing the pivots. To fully appreciate and profit from the pivots, you must buy at support while in an uptrend and sell at resistance during a downtrend. Every pullback becomes a buying opportunity in an uptrend, while every rally becomes an opportunity to sell in a downtrend. Understanding this axiom will allow you to hone in one of the high probability buy and sell zones of the market. Obviously, the Camarilla indicator makes this process as elementary as possible due to the color-coded pivots that directly direct you to buy or sell at certain levels. Pivot trend analysis. Pivot trend analysis may seem like common sense after it has been illustrated and explained, but trust me, many inconsistent traders have not yet made the correlation between this type of market behavior and how pivots factor into a trend. The use of pivots in a trend, whether Camarilla based, money zone, or otherwise, offers you the most accurate method of forecasting turning points in trend. Your ability to accurately diagnose the trend and identify the right actionable pivots can definitely put you ahead of the herd. Of course, your definition of what constitutes a trend does not have to be rigid. Not all trends are long, glorious moves in the market. A 2-day move in the same direction may be classified as a short term trend, which can still allow you to take advantage of market moves using the appropriate pivots. Identifying the most pertinent trend will allow you to utilize the right Camarilla levels for the best result. If it cannot be overstated how important pivot trend analysis can be at your trading. From time to time, the market can move in highly predictable waves. The pivots allow you to capitalize on this predictable behavior by offering you calculated value areas of support and resistance in your chart. The ability to program your brain to sniff out these opportunities will allow you to be a highly consistent trader for many years to come. Be aware, however, that the market only trends on an average of 30% of time, which means you must have the patience to wait for a confirmed trend in order to play this type of predictability in the market. The rest of the time is perfect for 2-day pivot analysis, pivot width analysis. Now let us look at the types of buyers and sellers. Responsive buyer and responsive sellers. A buyer that enters the market when price is below value is considered a responsive buyer. Responsive seller waits until price is above value before entering the market with sell orders. Responsive buying and selling will typically drive price back towards the mean, sending price toward an area that is considered fair value by the market. Therefore, price movement is short term oriented and lacks true conviction. Initiative buyer enters the market when price is at or above value. This type of buying would cause other buyers to enter the market along masses, causing price to explode to new heights. Initiative seller enters the market when price is at or below value. This seller is taking the initiative to push price to a lower area of value. These type of moves indicate a more confident buyer or seller, which is then reflected in aggressive price movement. The types of market days. There are 6 types of market days. These type of market days are repeatedly seen in the market, but no 2 days are over identical. Trend day, double distribution trend day, typical day, expanded typical day, trading range day, and sideways day. Trend day. Market is like a sprinter. The trend day is most aggressive type of market day. On a bullish trend day, the open usually marks the day's low, while the close usually marks the day's high, with a few ticks of tolerance in either direction. On a bearish trend day, the open will usually mark the day's high, while the market will usually close near the session's low. This day will have increased volume. This is an example of trending day. The open is at the lowest and the close is at the highest. Double distribution trend day. During this type of day, the market will usually open the session in a quiet manner, trading within a fair, tight range for the first hour or two of the session, thereby creating an initial balance that is narrow. Initial balance is traditionally defined as the price range of the first hour of the day, which is extremely important to professionals on the floors of the exchanges. The initial balance high, that is IBH, and the initial balance low, that is IBL, as important points of reference in order to facilitate trade between buyers and sellers. If the initial balance is too narrow, price will break free from the range and auction towards new value, creating range extension, which is any movement outside the initial balance. After the initial balance of double distribution trend day has been defined, price will break out from the range and auction toward new value where it will form a second distribution of price. This is the example of double distribution trend day. Price opened here, it consolidated here, it did break down from this consolidation range, it again formed a distribution area here, again it break down and again formed a distribution area here. This is known as double distribution trend day. Typical day. A typical day is characterized by a wide initial balance that is established at the outset of the day. On this type of day, price rallies or drops sharply to begin the session and moves far enough away from value to entice responsive participants to enter the market. The responsive players push price back in the opposite direction, essentially establishing the day's trading extremes. The market then trades quietly within the day's extremes the remainder of the session. The opening rally or sell-off is usually sparked by reactions to economic news that hits the market early in the day. This opening push creates a wide initial balance, which means the day's base is wide and will likely go unbroken. This is the example of typical day. Market opened here and fell almost 500 points till the CPR. From here it got reversed and traded within this range the whole day. Just remember that on typical day the initial movement within 1 hour will be very wide. Expanded typical day. This type of day begins the session with early directional conviction. However, price movement at the open is not as strong as that seen during a typical day. The initial balance, while wider than that of a double distribution trend day, is not as wide as that of typical day, which leaves it susceptible to a violation later in the session. Eventually, one of the day's extreme is violated and price movement is seen in the direction of the break, which is usually caused by initiative buying or selling behavior. During an expanded typical day, both the upper and lower boundaries of the initial balance are susceptible to violations. It's an example of initial expanded typical day, where the initial balance, which is represented by this box, got broken and price went back inside that box on later stage. Trading range day occurs when both buyers and sellers are actively auctioning price back and forth within the day's range, which is usually established by day's initial balance. The initial balance is about as wide as that of a typical day, but instead of quietly trading with these two extremes throughout the day, buyers and sellers are actively pushing price back and forth. This type of day is basically like a game of tennis. Responsive sellers will enter shorts at the top of the range, which essentially pushes price back towards the day's lows, while responsive buyers will enter longs at the bottom of the range, which pushes price back towards the day's high. This pattern will continue until the closing bell sounds. This is an example of trading range day. In this day, the market traded between these two ranges. From here, open here, from here, it went up, again came down, went up, came down, went up. It's like a tennis game. Sideways days. On this type of day, price is stagnant as both buyers and sellers refrain from trading. This type of session usually occurs ahead of the release of a major economic report or news event or in advance of a trading holiday. The initiative buying or selling required for a double distribution trend day never enters the fray, which leaves the market terribly quiet the rest of the session. This is an example of sideways day where there is no direction at all and there is no sharp movement. This is also an example of sideways days. Now let us look at some reversal setups. The first one is the extreme reversal setup. When a rubber band is stretched to its limits and then released, it snaps back in the direction from where it came from. The basic setup occurs when an extremely large candle forms, that is about twice the size of the average candlestick. While this candle may indicate that a continuation will be seen, the second bar of the pattern does not confirm a continuation and instead is an opposing candle that signals an upcoming reversal. When this occurs, you have a fantastic opportunity to buy below value or sell at a premium. The extreme reversal setup looks to capitalize on overextended situations in the market as responsive buyers and sellers will enter the market to push price back in the opposite direction. This is extreme reversal setup. This one is the first candle and this is the follow-up candles. This is bearish extreme reversal setup. This one is bullish extreme reversal setup. See, this one is a bullish extreme reversal setup. The first bar of the two bar setup is the extreme bar, which is the basis for the setup. This bar can be anywhere from 50 to 100% larger than the average size of the candles in the look back period. The second characteristics to consider when judging the extreme bar of the pattern is the percentage of the total bar, that is the body of the candlestick. If the extreme bar has a close percentage over 90%, there is a good chance that this bar could indeed lead to a continuation in the current direction. If the extreme bar has 60% coverage by the body, this is a better indication that a reversal may indeed occur, as a reversal may have already begun intra-bar, especially if the wick portion of the candlestick has formed at the end of the candle where the reversal is to occur. The second bar of the extreme reversal setup should be the opposite color of the first candle of the pattern. The second candle of the setup is just as important as the first, as this candle will either lead to continuation or a signal a reversal. If the bar is strongly opposes the first, the possibility of reversal increases. The first bar of the pattern is about 2 times larger than the average size of the candles in the look back period. The body of the first bar of the pattern should encompass more than 50% of the bar's total range, but usually not more than 85%. The second bar of the pattern opposes the first. Pattern psychology. When the scared money is selling, the smart money begins to buy, and vice versa. When the market sells off sharply in one giant candlestick, traders that were short during the drop begin to cover their profitable positions by buying. The traders that were on the sidelines during the sell off now see value in lower prices and begin to buy, thus doubling up on the buying pressure. This helps to spark a V shaped bottom reversal that pushes price in the opposite direction back towards fair value. You can see in this example. This is the extreme reversal bar. The following bar is a green one, which led to the recovery. The second one is outside reversal setup. For a bullish outside reversal condition to exist, the current bar's low must be lower than the prior bar's low, and the current bar's close must be higher than the prior bar's high. For a bearish outside reversal setup to exist, the current bar's high must be greater than the prior bar's high, and then the current bar's close must be lower than the prior bar's low. An additional requirement include bar size qualifier, which requires the engulfing bar be to be between 5 and 25% larger than the average size of the bars in the look back period. This criterion allows to further qualify the pattern as a viable reversal candidate. This one is a bearish engulfing bar or outside reversal setup, bearish outside reversal setup. Market participants are testing the waters above resistance or below support to make sure there is no new business to be done at these levels. When no initiative buyers or sellers participate in range extension, responsive participants have all the information they need to reverse price back towards a new area of perceived value. As you look at a bullish outside reversal pattern, you will notice that the current bar's low is lower than the prior bar's low. Essentially, the market is testing the waters below recently established lows to see if a downside follow through will occur. When no additional selling pressure enters the market, the result is a flood of buying pressure that causes a springboard effect, thereby shooting price above the prior bar's highs and creating the beginning of a bullish advance. This is the psychology of outside reversal setup. When this bearish candle and this bullish candle combines, it becomes a pin bar. Same with the case in reverse bearish candles. This one is a bullish candle, this one is the engulfing bearish candle. But if we combine these two candles, we get a bearish pin bar. The example of outside reversal setup is this one is bearish outside reversal setup. This one is bullish outside reversal setup. The doji reversal setup pinpoints indecision in the market, which can highlight profitable reversal opportunities. The doji candlestick is one of the most easily recognizable candlestick pattern in the market. This candlestick embodies indecision, which can help to predict an upcoming reversal in price, especially when the pattern forms above or below value. These are the different types of doji candlesticks. The pattern structure of a doji. A doji can provide a powerful indication of an upcoming price reversal. It must be used within proper context. A doji by itself cannot tell you the whole story about what the market is doing or where price is headed. However, if a doji has formed above value and is holding at a pronounced resistance level, either visual or pivot based, this can be a powerful indication of a downside reversal. Conversely, if a doji has formed below value and is currently sitting on support, you have the makings of a bullish reversal. What are important the factors to consider when judging the market's of a doji reversal setup. The first factor to consider is the current trend. For a bearish doji reversal to occur, the market must have moving higher prior to the formation of the doji. On the flip side, price should have been moving lower prior to formation of a bullish doji. There are many ways to judge this criterion. You can use a simple moving average and require that a bearish doji reversal candidate be above the average and the bullish doji reversal candidate below it. As long as the doji forms above a 10-period moving average for a bearish candidate or below the 10-period average for a bullish candidate, I am satisfied customer. Important factors to consider when judging the makings of a doji reversal setup. The second criterion that I use to confirm the setup is the closing price of the bar that follow the doji candlestick formation. For a bullish signal, I like the closing price of the bar that follows the doji to be above the high of the doji candlestick. For a bearish reversal, I want the closing price to the next bar to be below the low of the doji candlestick. Pattern structure of doji reversal setup is, this is an uptrend, here is the doji candle, here is the following candle which is a bearish candle, and a bearish trend reversal happened. The market is trending downward. Here it formed a doji candle, the following candle is bullish candle, and the reversal occurred and market moved up. The pattern psychology. The doji candlestick is the epitome of indecision. The pattern illustrates a virtual stalemate between buyers and sellers, which means the existing trend may be on the verge of a reversal. This is the example of doji reversal setup. The market is trending downward. At pivot level, CPR, bottom CPR, a doji candle formed, and then from here the following candle is a bullish candle and market rallied upward. Hope you find this video very informative. If you like this video, please do like and share with your friends and family. Please subscribe our channel and press bell icon. Thanks for watching.